The market on December 8th, 2025 shows a significant disconnect between seemingly stable equity markets and underlying stress in financial liquidity. While the S&P 500 and Nasdaq Composite are near record highs and corporate M&A activity is strong, e.g. IBM acquiring Confluent, Warner Bros. Discovery takeover battle, the global dollar funding system is signaling distress. The secured overnight financing rate is elevated, and the Federal Reserve's standing repo facility has seen its largest uptake in months, indicating stress in secured funding markets. This situation is described as a liquidity illusion. Broad money supply is growing, supporting asset prices, but it's not efficiently reaching interbank markets. Primary dealers are hoarding capital and showing reluctance to absorb new Treasury supply, as evidenced by a weak 3-year note auction. The Federal Reserve's transition from abundant to ample reserves has created friction in the repo market, the cardiovascular system of modern finance. The overnight secured funding rate is now above the effective federal funds rate, a structural anomaly suggesting a scarcity of balance sheet capacity among primary dealers. A critical event was the large use of the Fed's standing repo facility on December 1st, indicating dealers are overloaded with treasuries and lack cash to finance them, a consequence of heavy Treasury issuance and quantitative tightening. Simultaneously, the overnight reverse repo facility, which previously buffered liquidity, is nearly exhausted. This means new Treasury issuance now directly drains bank reserves, leading to volatility in secured overnight funding and increased reliance on the standing repo facility. Money market funds are growing significantly with institutional inflows, but dealer balance sheet constraints hinder their ability to fund the government, exacerbating repo stress. Despite narratives of monetary tightening, broad money supply is reaccelerating, supporting nominal asset prices in equities and real estate. Federal Reserve liquidity facilities show systemic liquidity stress rather than specific bank solvency issues. The bond market on December 8th showed a vote of no confidence, particularly in the front end of the yield curve. The weak 3-year Treasury note auction forced dealers to absorb more issuance, leading to higher yields and selling pressure across the curve. The Treasury curve bear steepened, with longer-dated yields rising faster, suggesting markets are pricing in a non-recession scenario and demanding higher term premiums due to concerns about future rate cuts reigniting inflation. Equity markets, while showing modest headline declines, experienced significant rotation driven by corporate events. IBM's acquisition of Confluent highlights a strategic shift towards real-time data streaming for AI, re-rating the data operations sector. A hostile takeover bid for Warner Bros. Discovery reflects defensive consolidation in media. Regulatory filings show other corporate actions, including an aerospace manufacturer acquiring a supplier, an automotive supplier going private, and a packaged food company's merger approval. Technology outperformed in equities, while utilities lagged due to rising yields. The low equity volatility index seems inconsistent with repo market stress, suggesting investor complacency. Globally, central banks are diverging. The U.S. Fed is expected to cut rates modestly, but forward guidance on balance sheet policy is a key risk. Euro area officials are pushing back against aggressive rate cut expectations, supporting the euro. Japan is nearing a rate hike, strengthening the yen and potentially leading to capital repatriation. Australia is expected to keep rates high, and Switzerland will likely maintain low rates to prevent currency appreciation. Geopolitically, U.S.-China tech trade is seeing political intervention, with approved AI chip sales to China subject to tariffs. This shifts strategy from denial to extracting economic rents, potentially spurring Chinese domestic chip development. The debasement hedge trade remains active, with cryptocurrency and gold acting as barometers for liquidity expansion and geopolitical uncertainty. A tech company continues to accumulate the leading cryptocurrency, funded by new share issuance. Though its stock has fallen, gold futures are above $4,000, supported by central bank buying and geopolitical tensions. Derivatives markets and sentiment indicators reveal a more defensive posture than equity indices suggest. Heavy put buying in tech and communications stocks and in a cryptocurrency mining stock indicates positioning for negative catalysts. Options on high-yield bond ETFs suggest concerns about corporate credit spreads. Equity sentiment shows complacency, while digital assets exhibit extreme optimism. Looking ahead, a bifurcated volatility event is expected around the upcoming Fed meeting. A moderate rate cut is priced in, but the Fed's communication on balance sheet policy is crucial. If the Fed characterizes repo stress as frictional and signals no immediate halt to quantitative tightening, yields could spike and equities might sell off. Strategic opportunities include hedging repo market stress with floating rate instruments, investing in data infrastructure companies, taking short positions in defensive tech names with bearish options flow, and short duration or yield curve steepener trades in bonds. This analysis is based on data as of December 8, 2025, from the perspective of a senior fixed income and equity strategist.